Good day once again. Welcome back to the class. This is lecture number 40 and we will be doing a recap on what we did about portfolio management, the choices, and then what we did talk about, the evaluation methodologies and considerations to be taken into effect. So, how should a portfolio be evaluated? We can look at it. That's the important buzzword because we're talking about returns on investment. So, we have to look at all the returns to be in excess of the risk that we've taken, whether the changes should be made in smaller proportions or we have to look at bigger performance valuations. The bottom line is we should get something in return for the monies that we have invested. The portfolio valuation is basically about returns to the risks that have been taken, the risk-return trade-off which we way back in the early stages of our lectures we had talked about. The important thing is that we must understand that this evaluation is all about the way portfolios have been managed, the way we are going to look at all the considerations that have to be taken into account. So we can have a little bit of knowledge about the risks that can be taken into the performance methodologies. So we can look at intelligent decisions that have been made, keeping in view the risk and return, and look at the relative performance evaluation and the relative performance comparisons, which would mean that we are going to evaluate the portfolio with a benchmark portfolio in ways to understand what has been the results of our portfolio or the portfolio that we are watching in comparison to the benchmark portfolio. This is one of the considerations that is taken into account, and we look at risk-adjusted performances to be looked at the best optimal level, and to also look at the return being greater than the risk that we've taken. We've got to look at evaluating the actual portfolio manager who is responsible for managing the portfolios. So we can evaluate portfolio managers as well, and then look at the constraints at the managerial level and how they impact on the decisions of a portfolio manager. So how well a portfolio is diversified and what is the evaluation period are two things that we had talked about, and we have to look at adequate returns on the diversifiable risk that we've taken. Since there is no way that we can avoid risk, we must understand that our returns will be based on how successfully and how significantly we've been able to manage the risks that are available and are obviously omnipresent in the capital market, which way we have found to be the best way in avoiding risk and then getting a better return or an investment. To do that, we measured returns. We measured the total value of the investment over an evaluation period. So we looked at the beginning value of a portfolio and the ending value of a portfolio, because that's the only way we can find out about the money matters related to portfolio assessments and evaluation. And we assume that no funds are added or withdrawn during this period, and then we can really find out what have we really earned from investing in a portfolio. And when we are investing in a portfolio, we understand we have to look at the change in the investors' total wealth. Because when we talk about wealth, we're talking about enhancements of wealth. When we talk about wealth, we're talking about the reason why somebody invested in portfolios. So to do that, we will be measuring the valuations and we'll be measuring the returns. Can we then have dollar or rupee weighted returns to talk about, or can we then talk about time horizon returns as well? But we need to look at the dollar weighted return first and capture the cash flows during the evaluation period and the equivalency to the rate of return. Cash flows affect comparisons to benchmark comparisons. The only way we can understand is equate initial value of the portfolio and look at the eventual value of the portfolio, which is the only better way to look at the dollar weighted returns. The difference between the beginning of a portfolio investment and the encashment of the portfolio and the ending values of the portfolio in rupee terms or dollar terms. We can also then look back at the thing that we talked about, time-weighted returns, and it captures cash flows during the evaluation period and the returns. We can look at calculating the returns relative for each time period defined by the cash flows or outflow. Money is coming in or money is going out. We use each return relative to calculate a compound rate of return. Every time we put in money back into the portfolio, we've got better chances of money is growing into the portfolio because of the effect of compounding, which is a much better way to look at things than looking at just simple interest rate. So compounding interest rate will give you better returns to look at when we are measuring returns on portfolios. If I were to be looking at returns of both sides, whether they're dollar averaged or time average, we can look at the results being different for both. Dollar weighted returns appropriate for investors of the portfolio. Time weighted returns are a good measure for portfolio managers. It suits them more. There is no control over outflows, there is no control over inflows, independent of action of client. It suits most to the manager of the portfolio, and then he can look at the time weighted return measure. One should look at the time factor more importantly than just the money matters. Remember, monies do not grow on trees, they will time to mature and grow. For the best optimal results on portfolios, it would not be a bad idea. In fact, it would be a good idea to look at time-weighted measures for returns. With the measures of return, we shouldn't forget about measuring risk as well. So risk differences cause portfolios to respond differently to market changes. Measuring risk would mean total risk measured by the standard deviation of portfolio returns. Non-diversifiable measures will be a securities beta. So if you're measuring risk, you're talking about risk as in betas and risk as in standard deviations. The estimates may vary, be unstable, and change over time as far as betas are concerned. To measure risk, this would be a good measure to measure the risk factors involved in volatility and variability, or measure risk involved in betas and standard deviation. While we're looking at measuring risk, we looked at the Sharpe's model of comparing reward to variability, RVAR, and the other risk-adjusted performance that we talked about was the Trainor's reward to volatility ratio, RVOL. Risk premium per unit of market risk, and higher the risk, the better the performance, implies a diversified portfolio. So we looked at RVARs in RVOLs or Sharpe's and Trainor's, or variability to reward ratios and volatility to reward ratios as being the measurements of risk-adjusted performances while we talked about measuring risk. This was a little bit different than talking about betas and standard deviation. This is more towards variabilities and volatilities. So, do we go for variability reward or we go for volatility reward? But it depends on the definition of risk. Total risk, we use variability reward measurement. Systematic risk, would rather measure it with volatility. If portfolios are perfectly diversified, rankings are either based on volatility or variability, the results are the same. The difference in classifications causes ranking differences. Reward in variability captures portfolio diversification. It is important to understand the results that will come up with measuring risk through variability or measuring risk through volatility. And both will have the same result if you're looking at diversification. How correlated are portfolios returns to market portfolio? You have to make a comparison between the portfolio and the market portfolio we discussed before. And we talked about the equation that we looked at previously of R2 being the estimation from the equation, where R2 was the coefficient of determination. The excess return form of characteristic line was talked about. The lower the risk, the lower the R2, the greater the diversifiable risk, and the less diversified it is. So, to measure diversification, we correlated the portfolio's returns to a market's portfolio. Remember, it has to be a benchmark with which you can relate the portfolio measurements, a benchmark with which you can measure risk, a benchmark with which you can measure rewards. And remember, we talked about Jensen's alpha as well, whereas Jensen's alpha would be the estimated alpha coefficient, which is a means to identify superior or inferior portfolio performances. We mentioned capital asset pricing model. If it is to be implied as an alpha with a 0, we would then be able to evaluate the performance measures on the basis of an alpha being greater than 0, or an alpha being less than 0, and alpha being equal to 0, where a greater than alpha's performance would be superior, a less than alpha 0 would be an inferior performance, and if it is equal would mean is equal to the market risk adjustments. So to measure the Jensen's alpha would be a good idea to make measurements as well. But there are problems in measurement we talked about, and problems in performance measurements based on capital asset pricing models and its assumptions, in which we talked about riskless borrowing. We talked about what should be the market proxy be, how long an evaluation period is. We should consider a 10-year period to be a fairly good way of evaluating. The time was talked about, and we consider a good period of evaluating time-based portfolio would be a 10-year period, in which we would understand and be able to study the returns over a fairly reasonable length of time. So 10-year period would be considered appropriate as far as I would find it good while measuring the evaluations of the portfolio, because these are measurement problems that we have to look at, because it is evaluating the performance of a portfolio manager, and it is about portfolio itself, the portfolio being measured and evaluated. We must focus on times instead of just the rupees or just the dollars. It would be a good idea to look at a longer span of time with a history of proper results that you could look at. So you could look at the riskless borrowing as far as capital asset pricing is concerned, and look at the adjustments that you will be looking at while trying to find out the best measurements and trying to focus on and avoid the problems of measurement. Measurements as in performance, or measurements as in duration, or measurements in determining the results. There are other evaluation issues that we talked about. Performance attributed to seeking an explanation towards the success or failure of a portfolio, which would then be analyzed on the basis of the investment policy and the investment assets which have been allocated while deciding what sort of a portfolio was constructed. We would also have talked about the analysis of the industry itself and the security within the industry for selection purposes. The benchmark selected could also result in a false impression by being a benchmark which is not appropriate to the measurement tool. There are differences due to asset allocation, market timing, and security allocation. Remember, these three things make about the changes in results as well: security selection, evaluating the results that are to be considered. Now, we talked about three broad categories of securities while we were investing in the portfolio, and we discussed that we could look at the assets included in variable results, in fixed results, and in future results. And we talked about equity securities, fixed income securities, and derivative securities, which would have meant, while I was referring to these as common stocks, preferred stocks, bonds, futures, options, and swaps to be included in the portfolio as being different classes. Since all this talk was about performance evaluation, since all this was about capital gains, we must understand that this was the prime reason for investing in capital markets and investing in a diversified product, which would mean investing in a portfolio. So the three reasons when one invests was, one, that you needed capital gains to enhance your wealth, the one prime reason that you invest. The other was to supplement your incomes through way of interest, by way of dividends, by way of regular incomes and regular dividends and interest. And the probability of your reinvesting in the portfolio by not using the dividend but reinvesting them. So appreciation is important, regular income is important, and there should be some sort of activity in the portfolio management process. The reason people invest in portfolios for safety purposes. So this was what we discussed about portfolio. There's one very, very important product that we haven't actually been gotten around to talk about. We've talked about bonds, we've talked about stocks, but we haven't talked about the third product, derivatives. So then what are derivatives? Derivatives are instruments whose values depend on the value of other more basic underlying assets or variables. Their value is derived from some other asset. A derivative is a financial instrument whose return is derived from the return of another instrument. Remember, the word derivative is from the word derive, and you derive the value, you derive the performance based on the original underlying asset or underlying variable. This is about futures. This is something new that will actually excite you. Forget about bonds, forget about stocks, focus on derivatives, but be sure these all are derived from bonds and stocks, because they will not exist if there is not an underlying asset associated with it. Since the past couple of decades, derivatives is now more in focus, more of interest to people, and people are more inclined to working more into this financial product than in using the bond market or the stock market as ways of earnings, livelihood, and building up on your wealth. So when we talk about derivatives, we look at the underlying assets, which could be either a financial asset, could be a commodity, may even be a real asset. These are the three underlying assets on which a derivative could be based upon: a financial asset, a commodity, and a real asset, from which the value, from which the strength can be derived for a derivative asset. Furniture being a derivative of wood. And similarly, to understand this, we can talk about the underlying sentiments of the derivative. Why do we have derivatives? The rationale for derivative assets has to be understood in context with the way the derivative assets came into being in United States itself. One of the reasons that we need to understand that initially derivatives came to help farmers, they came to help agriculturists. The first organized derivative exchange in the United States was developed in order to bring stability to agricultural prices by enabling farmers to eliminate or to reduce one risk. This risk was called price risk. So one of the rationales for derivative assets is to avoid or to minimize risk. It was also one of the reasons that this was initiated in the United States, to help out farmers, to help out people so that risk could be controlled or minimized, particularly price risk. But there is no universally satisfactory answer to the question what a derivative is actually. There is a lot of things to be talked about derivatives. Often, when a market participant suffers a large newsworthy loss, the term derivatives is used as almost as if it were an explanation. It is not. There are talks that a derivative is a time bomb, just waiting to explode. We have this misconception that a derivative is a product that results in a large loss. We have got a certain amount of negativity towards derivative assets or derivative products. It is the dreaded D word, D for derivatives and D for dread, D for disaster. It is nothing to be worried about. Derivatives are not disasters, derivatives are not dynamite, derivatives are not dread words. Derivatives are wonderful financial products that you can take use of. It is how you use derivatives and how you abuse derivatives which is going to make a difference to your financial wealth. You use it well, will bring you happiness. You abuse it, bring you sadness. So derivatives is one of the ways that you can understand a bigger way of improving on your wealth. Your financial capacities can remarkably improve by using derivatives, whose once again value is derived from an underlying asset. If there is no underlying asset, there will be no derivative. That has to be understood, that these derive their strength from an underlying asset. So futures and option markets are very useful, perhaps even essential parts of a financial system. We did talk about capital markets being a part of the financial system. We did talk about bonds and stocks being important, integral parts of the financial system, but we should also consider derivatives to be an important part of the financial system. So to understand derivatives, and the reason that we've included derivatives in this course is because this is something new that's happening here around this part of the world, and we must understand that futures and options markets have a long history of being misunderstood. Why are they misunderstood? Because there's not a lot of history behind understanding derivatives, and it's just very recently that even in countries like the United States of America has the excitement of derivatives been explored and begun to be understood. Derivatives is something new, so it is nothing to worry about because things are being studied about derivatives. We've talked about derivatives. There are derivative markets, different kinds of markets involved in derivative products. One of them is the exchange-traded derivative, which as implied from the name would mean derivatives or products being traded on the exchanges. These are contracts. Contracts are standard and there is virtually no credit risk. We are talking about exchange-traded derivatives. Traditionally, exchanges have used the open outcry method, but increasingly most modern exchanges are converting to virtually switching over to electronic trading, which would mean that open outcry method exchanges are now converting and transforming themselves into virtual stock exchanges. The Pakistani stock exchanges are no longer open outcry method exchanges. They're no longer probably physical exchanges. They're more now like virtual exchanges, whereby you do not have to come to the exchange to trade. Derivative markets are exchange-traded markets, and you trade in derivatives the same way you trade in regular stock markets. like the open outcry method, still being used in many countries. Another derivative market is the OTC market or the over-the-counter market. In over-the-counter market for derivative products is a computer and telephone linked network of dealers. A computer and telephone linked network of dealers at financial institutions, corporations, and fund managers. We're all linked together through a network of telephones and computers. Contracts can be non-standard and there is some small amount of credit risk involved. Remember, we're talking about over-the-counter where though there's no exchange involved, and we're talking about the comfort level of an exchange-traded derivatives market. Obviously, as the name is implying, there is a certain amount of credibility when you're talking about trading derivatives at the exchange. But there is a certain amount of risk involved when there is no exchange involved, and you're probably dealing directly over the counter with another man, another person, another institution, another fund manager outside the domain of the exchange. Exchange-traded funds, exchange-traded stocks are all much better than just over-the-counter products. So then, we need to understand what is the role of derivative assets. Why do we need derivative assets? Why do we need to have these time bombs, like people say? Derivative assets are best known derivative assets are futures and options contracts. Derivatives are not all the same. They have different variabilities, different values, different strengths. Some are inherently speculative, while some are highly conservative. It will depend on the underlying asset. Since these variabilities are obviously going to produce different variable results, we have to find out what sort of a derivative product can we deal in, a conservative derivative asset or a speculative derivative asset. More importantly, we need to study futures more, options more, because these are the more popular products of the derivatives market. The role of the derivatives assets can be used to understand the significance of future markets. Forwards has also played its part in the derivatives market. Here locally in this region as well, we had been dealing in the forwards market for quite a substantial amount of time, but that has since now been stopped. So we may not be having a forwards market anymore right now, but we do have a vibrant futures market right here in our own country as well. So once again, there are derivative instruments, more importantly the futures contract, more importantly the forwards contract, options and swap. And sometimes you are able to decipher the names and the meanings from the words futures, forwards, options and swaps. And when we look at the details of these products individually, and we'll be studying all these products separately as products of the derivatives market, we will understand the intricacies of the derivatives instruments more comfortably than we now know about them. What then are futures or forwards or swaps or options? We could understand a futures contract more. One, that we should understand that it is traded on the exchange. One, also we need to understand that it is an agreement to transact or an agreement to sell or buy like a forward contract, but in a different way than a forward contract. So futures contract is an agreement to sell or buy in future, and you do it on the exchange. So it would be an exchange traded future. It would be an exchange traded derivative. And you agree to buy or sell with another person in the future. As the name implies, we can understand it's all about futures and we are going to talk about the futures contract as a way of dealing in future, but with contract that has been drawn upon by a buyer and seller. The other component of the derivatives market was a forwards market or a forwards contract, which is a little bit different than a futures contract. Futures are traded on the exchange. Forwards are not traded on the exchange, are traded over the counter. Forward contract is an agreement to buy or sell an asset at a certain future for a certain price on the counter. The basic difference between the futures and the forwards is the one is exchange traded, the other is traded over the counter. In futures, you decide the price now, you settle it in the future. In forwards, the price is determined when you're going to settle the forward contract. The option contract was the third participant of the derivatives, the third instrument in the derivatives. And the options contract gives the owner of the contract a right, but not an obligation to buy or sell in the future. Option contracts are both traded on the exchanges and over the counter markets as well. So an option contract would be a contract that gives the owner of the contract the right, but he is not obliged to go all the way for the buying and selling option that he is exercising, as the name is implying, option. He has the option to exercise the option that he is holding on to or let it go. One of the last components of swaps was to be discussed in the derivative instruments. The swap is an agreement to exchange cash flows. The word obviously means an exchanging. The swap is an agreement to exchange cash flows at specified future times according to certain specified rules decided now. The price is decided now, the rules are specified now, and then you decide what product to swap with which product, or what priced swap has to take place. It could be selling one product and buying it with another. Remember we talked about rebalancing portfolios? Well, it's actually about swaps. You switch over positions. You change the values of the products. The types of derivatives we talked about was, one, options that I just mentioned to you about being one of the products. Two, we talked about future contracts, which I talked to you about firstly, and then I talked to you about forwards as well. But we need to understand these products in detail. We might cover some right now in this lecture, and we might cover some in the lectures that are coming. And there will be product characteristics that we will have to talk about when we're talking about derivatives. Futures, forwards, options, swaps have to be understood. Once again, the reason that I need to make you understand these in a much better way are because we understand these things the way they have to be understood, and we need to understand options in detail, forwards in detail, swaps in detail. So once again, we must rejuvenate our memories and understand an option is the right to either buy, the option is to buy or sell something at a set price with a set period of time. It is an option. It is not an obligation. There is no force that is going to make you use that option. So an option is the right to either buy or sell something at a set price within a set period of time. The right to buy or the right to sell. The right to buy in the option market would be called a call option. Just clear your heads, clear your minds, because these words are going to confuse you. The right to sell is a put option. Remember to memorize these words, they're going to confuse you. So it's best that you understand these terminologies right now before things get out of hand. So the right to buy is a call option, the right to sell is a put option. You can exercise an option if you wish to, but you do not have to if you don't want to. It's an option. So buying is calling, selling is putting. You have call option as in buying and a put option as in selling. You go long in a put option, you go short in a call option. But that's not right. The confusion thus created was to make you realize we understand calls as in going long, we go short as in going put. So buying is call, selling is put, call is going long, put is going short. So you do your exercise well to understand and clear your confusions about the words calls and puts, because these are going to mean new things into your dictionaries. Calls and puts in derivatives, it's not buying and selling in derivatives. The other thing we needed to understand was future contracts. And what were future contracts? So we talked about future contracts being something in which you involve a promise, a contract, by exchanging a product for cash by a set delivery date. In a futures contract, you settle the price now, you settle the quantity now, but you set a delivery date for times to come. In the future, the price is settled, the quantity is settled, the time is settled in advance. What is going to be the time where you're going to exchange monies for product or products for money? So, futures contract deal with transactions that will be made in the future but have been decided upon now. 2 time periods, 2 time zones are involved. It's now and the future. Since future is unobservable, you make decisions now to avoid any ambiguity, to bring about clarity, to bring about certainty, and to risk minimize. You do a futures contract by deciding the price now, by deciding the quantity now, but settling in future. That is what a futures contract is. Future contracts are different from options. Future contracts are different from forwards as well. We talked that forwards are traded over the counter, futures are traded over the exchange. That was one basic difference. Now, if we were to understand futures being different than options, that has to be explained as well. That how different are futures from contracts in options. So, the buyer of an option can abandon the option, abandon the contract if he or she so desires. We've talked about options, we've talked about futures. We're trying to redo these again and again because these are absolutely new things to you perhaps. They're absolutely new things to millions of people who've actually studied finance. The buyer of a future contract cannot abandon the contract, whereas the holder of an options contract can abandon the contract. It's about obligations and options. In a futures, you have to go all the way to complete the contract. You cannot get out of it. You have to complete it. In an option, you can always abandon it whenever you want to. I hope this makes it clear for you, because you need to understand. But if you need to understand a little bit more, futures contract example can be given to you so that you understand the futures contract in a more clearer way, so that you are not able to confuse futures with forward or futures with options or options with forward. They're all different things altogether. For your convenience, for you to understand the example of a futures contract, you can look at the slide where the example has been given so that you can understand that the futures market deals with transactions that will be made in the future. A person who buys a December US Treasury bond futures contract promises to pay a certain price for Treasury bonds in December. If you buy the Treasury bonds today, you purchase them in cash or you purchase them in the spot market, which brings us to the word, the spot market. So we have a spot market, a regular market, and a futures market. A regular market would be a market where you're dealing now. You're doing transactions now, currently, and you sell them in a few days' time. The futures market is all about settling matters in the futures. But in the spot market, in the cash market, you settle your accounts immediately in cash, immediately in the market. So whatever you're buying now in the spot market can be sold in the futures market. So you buy something on cash right now, but you buy something on margin in the futures market. You do not need to use hard cash to the entire amount in the futures market. You can use your margin account, a fraction of your investment, to play the futures market. A futures contract involves a process called marking to market, mark to market, or M&M. To understand the values of the future contract, we must understand that although all results are for the future, all contract finalizations are for the future, but you must evaluate the money actually moving between one account and each day as prices move up and move down. So you evaluate all future contracts on a mark-to-market basis, or you evaluate all future contracts on a daily basis related to the price of the contract on a daily day-end basis. A forward contract is functionally similar to a futures contract. However, there is no marking to the market on a day-to-day basis. You do not evaluate a forwards contract on a day-to-day at the end of the day basis. But you do that in the case of a futures market. You have end of the day evaluations for the contract. You have end of the day evaluation. But in the forwards contract, remember, futures contracts are marketable. You can rebuy or resell future contracts. You cannot resell or you cannot rebuy or you cannot market a forwards contract. I hope by now you're more clear about forwards, futures, and options. It is important for us to understand because these are entirely new names into the financial world. Not really new, but as students, I expect perhaps you have not really focused on the derivatives market as yet. The word that was once left behind was swaps. We talked about swaps. We need to understand it a little bit more. Swaps would be an arrangement in which one party trades something with another party, swapping positions, swapping products, swapping prices, swapping your risk. You do this. You do this to understand all this while dealing in swaps. So the swap market is a very large market. It is maybe $1 trillion market outstanding in the market right now. You keep rebalancing your positions. It's done frequently in the money market, not so maybe in the stock market, not so maybe too much in the bond market, not so maybe in the portfolios, but more so in the money market. But swaps are ways to shift risk, to hedge risk, and avoid any untoward situation by holding on to the asset which might not give you a good result in the end. Different types of swaps. One of them would probably be interest rate swap. An interest rate swap is something in which one firm pays a fixed interest rate to a sum of money, a fixed interest rate on a sum of money, and receives from some other firm a floating interest rate on the same sum. Sounds confusing, but it is. But you must understand, we're talking about swapping fixed interest rates with a floating interest rate. So you can swap interest rates. What else can you swap? You can swap foreign currency as well. That would be called a foreign currency swap, shifting from one currency to another currency for safety reasons, for profitability reasons, and for hedging risk reasons. So, in a foreign currency swap, two firms initially trade one currency for another. Let's say dollar to euro or euro to pound sterling. You switch over international currencies, any currency that's marketable globally. So, in the foreign currency swapping position, two companies or two institutions will initially trade one currency for another. Subsequently, the two firms exchange interest payments, one based on a foreign interest rate and the other based on a US interest rate. The first thing we talked about was swapping interest rates, being fixed or floating. This is what I'm talking about, foreign currency exchange, swapping a foreign currency with the US dollars or local currency, and then finally the two firms re-exchange the two currencies. You could have a foreign interest rate, you could have a US interest rate, and then you could then finalize the deal by exchanging or re-exchanging the two currencies. Sounds complex, sounds confusing. It is, yes and no. It is confusing in the beginning, but you'll have more clarity as things go by. Which brings us to the subject of product characteristics. We've talked about futures, we've talked about forwards, we've talked about options, we've talked about swaps. These are going to be the four major components of the derivatives market that we've been studying and will study ahead as well. Four products in the derivatives market. Now, there are certain characteristics about these products that you must understand. Both options and futures contracts exist on a wide variety of assets. We talked about assets being commodities, the assets being real assets, or the assets being financial assets. There is a wide range of assets available on which options and futures can be based upon. Options trade on individual stocks, on market indices, metals, interest rates, future contracts. The world is at your feet in options. The options to trade anything. Once again, you could trade on individual stocks, market indices, metals, interest rates, futures contracts, because it's an option. You understand this by being able to understand this more when you read it again and again and again. Futures contracts trade on products such as wheat, live cattle, gold, heating oil, foreign currency, T-bills, and indices. Futures can work in the same way as an option, but do not confuse options characteristics with the futures characteristics, where we talk that futures have to go all the way. Options is just an option. You can abandon it whenever you want. So, the product characteristics in futures and options are the same in many ways, are a little bit different as well. There are other product characteristics of the derivatives instruments. We just had a look at the futures and we just had a look at the options. Remember, just focus that the underlying asset is that which you have the right to buy or sell with options, or to buy or deliver with futures. Did you find anything different? Did you notice anything different? Buying is the same. One you sell, the other you deliver. You have a buy or sell option, but you have a buy and deliver in futures. You can buy and settle or buy and sell or abandon in an options market, but you have to buy and deliver in the futures market. And the futures market characteristic was that it is marketable. The forwards characteristic was that it is non-marketable. These were the product characteristics that we discussed. We talk about these things in further detail in lectures to come, but this is going to bring you some new life to your meaning about derivatives, and then we can be talking about maybe listed derivatives or non-listed derivatives in lectures to come. But focus on this subject more now, because this is absolutely new, but it is absolutely brilliant once you get to know the derivatives instrument, the derivatives market, and the derivatives product. Thank you for being with me. Talk to you again.